Little change on Wall Street a year later. 1 year after the collapse of Lehman Brothers, the surprise is not how much has changed in the financial industry, but how little. Backstopped by huge federal guarantees, the biggest banks have restructured only around the edges. Employment in the industry has fallen just 8% since last September. Only a handful of big hedge funds have closed. Pay or compensation is already returning to pre-crash levels, topped by the 30,000 employees of Goldman Sachs, who are on track to earn an average of $700,000 this year. Nor are major pay cuts very likely, according to a report last week from J.P. Morgan Securities. Executives at most big banks have kept their jobs. Financial stocks have gone up since their winter lows. The Obama administration has proposed regulatory changes, but even their backers say they face a difficult road in Congress. For now, banks still sell and trade unregulated derivatives, despite their role in last fall's chaos. Radical changes like pay caps or restrictions on bank size face overwhelming resistance. Even minor changes, like requiring banks to disclose more about the derivatives they own, are far from certain. Coming on the same weekend as the 11th hour bailout of the giant insurer AIG and the sale of Merrill Lynch, Lehman's failure was the climax of a cataclysmic weekend in the financial industry. In the days that followed, nearly everyone seemed to agree that Wall Street was due for fundamental change. Its heads I win, tails I'm bailed out model could not continue. Its 8-figure paydays would have to end. In fact, though, regulators and lawmakers have spent most of the last year trying to save the financial industry rather than transform it. In the short run, their efforts seem to have succeeded. Citigroup and other wounded banks have avoided bankruptcy, and the economy has sidestepped a Great Depression, or at least so it seems for now. But the same investors and economists who predicted, and in some cases profited from, the collapse last fall say the rescue has come at an extraordinary cost. They warned that if the industry's systemic risks are not addressed, they could cause an even bigger crisis in months or years, not decades. Next time, they say, the credit of the United States government may be at risk. Simon Johnson, a professor at the Sloan School of Management and a former chief economist of the International Monetary Fund, said that the seeds of another collapse had already sprouted. If major banks are allowed to keep making bets that are ultimately backed by taxpayer guarantees, they will return to the practices that led them to underwrite trillions of dollars in bad loans. They will run up big risks. They will fail again, and they will hit us for another big check, he predicted. We've taken a lot of steps for the worse and not for the better in terms of the structural underpinnings of our capital markets. We have to change the rules and correct the fundamental flaws in the financial system. Critics of the industry argue that the pullback in risk will only be temporary without deep regulatory changes. Investors will lend money to the financial industry on easy terms. In turn, financial institutions will use that cheap money to make risky loans and trades. The banks will keep the profits when their bets pay off, while taxpayers, yes, U.S. taxpayers, will swallow the losses when the bets go bad and threaten the system. Somehow, that is simply just not right. Economists call the phenomenon moral hazard. Bankers have a different term, IBG. The phrase implies that by the time a deal goes sour, I'll be gone after having received a sizable bonus. So yes, once again, this is about greed. Pure greed. Despite the predictions last year about pay cuts, those bonuses appear very secure. One economist at J.P. Morgan in London predicted this week that 8 major American and European banks would pay the 141,000 employees in their investment banking units $77 billion in 2011, if it makes it that far. Because the rewards are so rich, the banks will not change unless regulators and lawmakers force them. I don't know anyone on Wall Street who goes to work every day thinking of anything but how to increase their bonus, said one economist. To prevent a replay of last year's crisis, investors in financial institutions, especially bondholders, must believe that they will lose money if banks fail. You need to send that very strong, clear signal to restore market discipline. But legislation that would allow regulators to close giant institutions in an orderly fashion has been stalled for months. So too have efforts to create a systemic regulator that would focus on the broader risk that might occur from the ripple effects caused by the failure of one major bank. Another proposed change would require banks to list and trade derivatives through a central clearinghouse, just as stocks and options are traded through exchanges, but it has yet to go anywhere at all. The term derivatives includes a variety of financial products, including contracts whose value changes as interest rates move, and insurance that pays off if a bond defaults. Derivatives drove the boom before 2008 by encouraging banks to make loans without adequate reserves. They also worsened the panic last fall because they inherently tie institutions together. Investors worried that the collapse of one bank would lead to big losses at others. Requiring that derivatives be traded openly sounds like a relatively small change, but it could have important effects. Exchange trading would open pricing for derivatives so banks could not hide money-losing positions. Banks would have to put up money as positions moved against them, since the exchanges would seize and sell derivatives that were not backed by adequate margin. That move would help avoid the situation AIG faced last year after it wrote hundreds of billions of dollars of credit insurance and had no money to make good on its promises when the bonds defaulted. But critics say that even the proposed changes would not go far enough because they would exempt some complex derivatives from exchange trading or clearing. Moreover, some banks oppose opening derivatives trading because it would cut their profits by making pricing more visible and, as a consequence, competitive. For now, legislation to force derivatives trading onto exchanges has stalled, and banks are still writing contracts with limited regulatory oversight. The off-exchange derivatives market is still the wild, wild west. And yes, so, in effect, in essence, nothing has really changed on Wall Street or in the financial institutions that brought about the economic worldwide crisis. Nothing really at all. The greed, yes, pure greed, it still goes on. Overcompensated banking executives or bankers making way too much money. So, when will it change? Anyway, everything is connected. And yes, everything that must change rapidly. And these are more signs of the end times transition days. Transition is happening. It must happen. And it is ongoing daily. And there are many, many signs in many, many different ways.